Hi, this is Stan, the annuity man, with my webinar that I think is very important called Building Your Guaranteed Income Floor. Thanks for joining us and spending your time with me. This is a very important topic, and I think the way that I look at annuities and the way that I look at how annuities fit in building your income floor is very important. So let's get started. Number one, I am the top independent agent in the country. I'm licensed in all 50 states. So if you're in Hawaii or wherever, we can handle you. I'm sitting right now in Ponte Vedra Beach, Florida. That's where we're based, but my staff is located in other states as well. I have published 7 books on annuities. I have an 8th one on the way, and I am a prolific writer of articles for everywhere from the Wall Street Journal to Investors Business Daily, and those are all on my website if you want to read that. I'm all about education and giving you enough information so you can make an informed decision. So let's go through the books I've written. The latest one is the Fixed Index Annuity Owner's Manual. It took me a while to write this just because it is such a overhyped and oversold product that I really wanted to make sure that I was going to be crystal clear on my explanations, the good, the bad, the ugly of this. And this is a game changer for the industry. So that's the newest one. The first one I wrote was Qualified Longevity Annuity Contract Owner's Manual, which is kind of a new pension product for the IRAs. I also wrote one on immediate annuities, single premium immediate annuities. Also one on fixed rate annuities. The industry calls them MYGAs, multi-year guarantee annuities. And also income riders, which are the guaranteed benefits attached to typically an indexed or variable annuity. But this book really covers just that guarantee, which is very important because once you attach that guarantee to one of those products, one of those deferred products like a variable or index, you really should focus solely on the income rider as the guarantee, and that's where your decision should be made. Also, deferred income annuities, which is it's kind of new, but it's a cousin to an immediate annuity. You can defer. It's a deferred pension, and we certainly will show that in today's webinar on how to use that. The first book I wrote a long time ago, The Annuity Stanifesto, is kind of covers everything. Before when I wrote that book, QLACs weren't even around, so QLACs aren't inside the Annuity Stanifesto, but every single annuity type, history, etc. is there. And I'll send you all of these books for free, no obligation, no cost, no catch. Just email me your physical mailing address, not your email, your physical mailing address, and I will send you in the mail a package of my books, and they're quick, easy reads, and you'll be able to fully understand these products, the good, the bad, the limitations. These aren't sales pitchy books. These are books that you can refer back to. There's all kinds of, I write in a bullet point, easy to understand fashion, so you're going to be able to fully get what these products do and what they don't do. My whole mantra is will do, not might do, and you'll see that on my cards and all my stuff and all my books. And will do, not might do means you buy annuities for the contractual guarantees. You buy them for what they will do, not what they might do, not some hypothetical, theoretical, back-tested, projected number, pie in the sky, agent return scenario. That sounds fantastic. You buy them for Armageddon. You buy them for what the contract is going to give you, because annuities are contracts. They are not investments. So with that being said, one of the things about annuities that's very important is the claims paying ability of the annuity carrier that you're buying from, right? Now, everyone's familiar with AM Best and Moody's and Standard & Poor's and Fitch, and they have the A ratings, A plus, AA plus, whatever. And none of us really know kind of what that is. Comdex is a company, is a ranking system from 1 to 100. It's actually, 1's horrible, 100's perfect in their eyes, but they take the compilation of all 4 rating services and then assign a score. Now, on my site, I give this away for free. You see that middle tab, resources. If you click resources, you're going to pull Comdex rankings, and at the very bottom, you see that screen, that green button, download your free Comdex report. Every month, we update that Comdex report so that you can see what the carriers, the ratings of the carriers, and the Comdex rankings. For example, here's kind of a shot of one. You see AM Best, Standard & Poor's, Moody's, and Fitch, and then to the right-hand side, you see a Comdex ranking. 100's perfect. And it goes all the way down. 20-page report. You can download it for free. You don't even have to sign up for it. The financial industry uses this all day long. It's amazing how much this is downloaded. But always do your homework on the carrier. And I represent pretty much all carriers. So when I do a quote for you, you'll see all carriers, and then we can have a discussion on which one we feel is best for you. Okay, with that being said, all annuity solutions, including the income flooring stuff we're talking about today, really come down to two questions. And the first question is, what do you want the money to contractually do? That's basic. So what do you want it to do? Please don't say reasonable rate of return, because that's not contractual. Please don't say market growth, because that's not contractual. Give me a tell me exactly what you want to do. I want income to start now, or I want income to start later, etc. The second question is, when do you want those contractual guarantees to start? Okay? That's it. What do you want the money contractually to do? When do you want those contractual guarantees to start? And with your income flooring, there's a couple more things that we're going to need to know, but that's really the basics. Okay? Now, there's 4 places annuities really fit into your portfolio. And they are legacy, income, long-term care, and safety. Okay? So those are the 4. Notice there's not growth. Notice there's not market growth anywhere. These are the 4 things. What we're going to be talking about today primarily is income, but we can throw in some legacy and some safety as well as we move forward with our income flooring plans. Okay, annuities is a transfer of risk. Okay, so you're transferring the risk to the annuity company to pay you for the rest of your life or to protect the principal, etc. So I come up with an acronym called PIL. P is for principal protection. Okay, I is for income for life. L is for legacy, and the other L is for long-term care. All right, that's it. So if you say, Stan, I'm not sure I need an annuity, you're going to look at this PIL acronym and say, okay, do I need principal protection? Do I need income for life? Do I need legacy? If you don't need any of those, you don't need an annuity. It's really, really that simple. Okay, so with that being said, let's start with building your income floor. All right, building your income floor. There's 5 reasons why you should try to contractually guarantee your income floor. Okay, so let's go through those 5 primary. This is my opinion. Okay, the first one is peace of mind. The peace of mind of you getting a contractual guarantee that you can, a lifetime income stream that you or you and your spouse could never outlive. That's peace of mind. Peace of mind is Social Security. Peace of mind is a pension. Annuities can provide that same type of peace of mind when it's structured properly. The second thing is having your income floor in place will make you a better investor. I want you to think about this for a second. If you have your income stream in place, the monthly expenses plus, the lifestyle money that you need, and that's coming in every month. That's hitting your bank account every month, regardless of how long you live. The other money, the other stock market type money that you invest, you're going to be a better investor. I'm just going to tell you that right now, because you don't have to worry about peeling off, doing a systematic distribution of the money from growth. Building an income floor will make you a better investor. I will guarantee that. Transferring risk is needed for most portfolios. Some don't. Okay, some of you guys are going to go 100 miles an hour and you don't need an annuity ever. You don't need a guarantee ever. You don't need lifetime income ever. But most people with a portion of their portfolio, you need to transfer some risk, meaning you need to give the money to a carrier to guarantee either a lifetime income stream or principal protection, etc. All right? And then the continuation of lifetime income stream for your spouse. A lot of us out there, we have the spouses that really aren't into the market. They don't care. They just want to go see the grandkids and the kids. All right? When you build an income floor, I'm going to encourage you, if you have a spouse or a significant other, to set up the income stream joint. In other words, it's going to pay you for the rest of both your lives. And if you die, then your spouse continues that income uninterrupted and unchanged for the rest of their lives. Now, also, too, we can structure that income so that 100% of any unused money will go to the beneficiaries. One of the things people get confused about is they say, Stan, if we die, the money goes poof, the insurance company keeps the money. You can structure it that way, but you don't have to. All right? So, the last thing, never outlive your money. Think about never outliving your money. People say, well, Stan, what's the return on investment on an immediate annuity or a lifetime income annuity? I really don't know that until you die. I will tell your beneficiaries at your funeral. I'll be very nice. I'll stand up there. I might even wear a suit. Doubt it, but I might. And I'll say, here's the return on investment on the lifetime income stream that was purchased. Up until that, it's a transfer of risk. Okay? So here's how I can help. All right. In addition to representing every company out there, here's some action steps. So just We're going to cover these at the end, but I want to cover them at the start because this is how the magic works. This is how the sausage is made of getting a lifetime income stream and a guaranteed income floor in place. Order my books. My gift, no cost or obligation. Request a quote, okay? I don't want you to be tentative. I'm not going to call and I'm not going to pound you and I'm not going to say, hey, you got to buy. I'm not going to do any of that stuff. Okay, we're going to have a grown-up conversation on the phone and I'm going to send you the quotes. And we're going to go over them. And in combination with the books, you're going to make a qualified decision, an informed decision. Again, no cost or obligation. No one's going to show up at your doorstep. You're going to deal with Stan the Annuity Man, and there's no pesky phone calls. We're not going to pound you into oblivion. If you want to talk to me, let me know, because you can set up a specific phone appointment, and we'll spend time on the phone going over the quotes, and then I'll let you make your decision on your own term. So there is a schedule a call button on my site. So go to my site and look at that. So let's get going. Income flooring using annuities. It is a complete transfer of risk. You're transferring the risk to the carrier to do exactly what you specify and what you want the contract to do. It's a non-correlated asset, meaning it's not market attached, meaning if the markets go into the toilet, it's your plan, your income flooring plan will not change, period. So it's non-correlated. The guarantees are going to be backed by the claims paying ability of the carrier. So again, going back to the COMEX rankings, it's very important that you understand the company backing up the guarantee. Because if they're going to back it up for life and you live to 150, you need to know that they're there, right? Key, you're never going to outlive your money, okay? I need you to do me a favor and try to not think of annuities as investments. It's hard because you've been investing your whole life. You're looking at return on investments and annual yield and all this stuff. Annuities are not investments. Annuities are contracts. I need you to look at them as contracts, as guarantees, and not try to compare them to a bond or compare them to a mutual fund or compare them to an ETF. Okay? Because annuities are the only product on the planet that guarantee lifetime income regardless of how long you live. And all income, all of the annuity types we're going to see today that I'm going to show you are return of principal and interest. So when you turn on an income stream from an annuity, you're getting your money back with interest. Anyone who tells you otherwise is lying. Anyone who tries to show you type of growth scenarios and non-guaranteed scenarios to offset is just being misleading. You're getting your money back with interest. All right? That's every single annuity. It's a life expectancy bet. So it's the only product on the planet that's going to pay you for as long as you live. I have hundreds and hundreds and hundreds of clients that their account's at zero, and it's been at zero for 10, 12 years, and they're getting their lifetime income stream. Still, that's called transferring the risk, okay? So let's look what comprises your income floor. Some of you that have pensions or government workers or older companies, if you have that, great. You're fortunate because the rest of us don't have that. Social Security, best inflation annuity on the planet because it has nothing to do with life expectancy. It has to do with votes. It's a political football, but it is a pension. So you can't hate annuities and hate your Social Security. Dividend stocks, ETFs. A lot of you have dividend stocks that you're peeling off, the coupon. That's great. That's part of the income floor. Municipal bonds, corporate bonds, REITs, those type can be part of the income floor. Rental property. A lot of you have rental property that can be part of the income floor. And then RMDs. You literally have to consider RMDs as part of your income stream. Because a lot of you out there say, Stan, I do not want to take RMDs. I don't need the income. But guess what? The IRS doesn't care. They're going to tap you on the shoulder and say, hey, oh, by the way, we need to get some taxes on that money. So when you take RMDs, required minimum distributions from your IRA, you got to consider that as income. And then obviously annuities comprise. So pension, Social Security, dividend stocks, ETFs, municipal bonds, all these things are what comprise your income floor. All right? So the rules of annuity income floor are pretty basic. Make your decision on the contractual guarantees only, period. And that's all I'm going to show you anyway. Do not try to time rates. Do not call me and say, Stan, I'm going to wait until rates go up. Well, if you're going to do that, then you got to factor in the payments that you would be missing if you purchase the income flooring annuity now. And by the way, annuity companies are sitting at the table with the marble floors, and they're sitting there and they're asking the same questions and they're trying to price it. So it's a tough decision. And remember, income annuities, the primary pricing mechanism is life expectancy, not interest rate. So don't be a guru, all right? Janet Yellen's, you can't time that, or whoever the leader of the Fed is at that time, do not try to time it. This is an investment. It's a contract, okay? One of the things about that separates me from everybody out there is one of the rules I say is use as little of money as possible in an annuity to contractually achieve what you're trying to do, especially with income flooring. And I know the sales gods are rolling over in their graves and the annuity industry is saying, no, Stan, don't do that. But I'm telling you right now, the way to do income flooring using annuities is to use as little money as possible. Okay? I know, it's crazy, but that's true. Consider laddering strategies. A lot of people say, Stan, I know, I hear you on the interest rates, but I just don't want to go all in right here. Then we can ladder. We can ladder the purchase date over a time period, or we can ladder the start date. We can do all kinds of laddering. We're going to cover laddering later on in the presentation. And then lifetime income pricing is all about life expectancy. Once again, it's a life expectancy bet with the carrier. They price it based on where they think you're going to die, and you say, I'll take that bet. I think me and my spouse will outlive that, and if we do, you, the annuity company, are on the hook to pay. That's the value proposition of an annuity. And one thing that you got to understand, annuities are commodities. Shop them all. That's the reason I represent pretty much every carrier out there. Shop them all. Quote them all. If someone's showing you one, if some agent or advisor is showing you one, they either don't have good inventory, bless their hearts, or they're trying to go on a trip to Bora Bora and drink for free with either their wife or their girlfriend. But there's no other reason than that. Either they have bad inventory or bad intentions, but you need to shop all carriers, and we'll do that for you, okay? The true benefit of a lifetime income stream is there's no ROI till you die. Remember, we talked about that. You cannot figure that out. Yes, you can run numbers until you live to 95 and say, hey, Stan, it was a 6.1 whatever return if I lived to 95. But you can do that. But they're really, until you die, we can't run those return on investment numbers. And remember, I'm going to say this over and over again, all annuity lifetime income, whether it's from an income rider, deferred income annuity, whatever it is, SPIA, whatever, is a combination of return of principal and interest. So when it gets to zero, I mean, your goal truly is to get in the annuity company's pockets, right? Eventually. You want to outlive their life expectancy projections. All right? So let's talk about how the sausage is made on all of this. Let's go over that. How lifetime income is priced. Life expectancy. There's life expectancy tables out there. So it's no more difficult than that. And if you add another person to the income stream, so if you do a joint policy, they're going to base it on 2 lives. And if your spouse is younger than you, they're going to primarily focus on that younger person. All right? So life expectancy is the key. It's a bet, like we talked about. And interest rates play a secondary role. By the way, if you say, Stan, what interest rate are we talking about? We're talking about the United States 10-year Treasury, the U.S. 10-year Treasury. That's the benchmark. That's the bogey. That's the one you got to follow. Okay? So when people do back-tested numbers, it's misleading because the 10-year Treasury was at different levels. But that does play a part of the pricing, albeit secondary. All right? So there's a couple ways that you can do income flooring. I recommend, remember the list that we just went through of all the items, the Social Security, the pension, the dividend stocks, the REITs, the bonds, etc. What I'd like for you to do is add all that up and then tell me what that gap's going to be. Now, you can't factor in for inflation. We'll cover that later. But you can say, Stan, we need $1,222 to fill that gap. That's the way to do it. So we can reverse engineer the quote to solve for that specific monthly number. That's one way to do it, okay? The other way is, and then I'll tell you exactly the premium needed. The other way is to say, hey, here's a lump sum, Stan. What would the guarantee be based upon the exact specific parameters I'm providing? In other words, you're going to tell me, here's when I want the income to start. Here's how I want it to work. I want it to be my life or joint life, and I want all the money that's remaining to go to my beneficiaries. Or I just want the highest payout. I want life only. You just got to be specific with how it's going to work. Typically, I run $100,000 because it's an easy multiple. It's a contractual multiple. It's just saying, here's my $100,000 quote. How much would $200,000 bring me? Just multiply that income stream by 2, okay? Typically, and this is interesting, I'm probably the only person going to tell you this, anything over $1 million, a lot of the companies give you poorer pricing. They call it the healthy, wealthy, wise rule, meaning they think you know something that they don't know, they meaning the annuity company. So typically $1 million and below, is where the preferential pricing is for the customer. If you say, Stan, and I have a lot of these that say, Stan, I've got $3 million, then we'll probably split them up between 3 or 4 companies so you can get the best contractual pricing and the highest guarantees. So this is just, knowledge. Most people don't know that. So if you go to New York Life or Guardian or Pac Life or MetLife or whoever you choose and say, hey, I want to give you $5 million for immediate annuity, you're probably not going to get as good a pricing as if you did 4 or 5 different companies. So that's just food for thought. All right. Here's the quote information needed. So it's very basic. You got to tell me if it's IRA or non-IRA money. Why? Because the taxation is different with different products. In an IRA, all money coming out of an IRA is taxed the same, right? Ordinary income levels. But in a non-IRA setting, okay, a lot of these products like deferred income annuities and single premium immediate annuities are going to have tax beneficial income streams, meaning you're going to get, they're annuitized, meaning you're going to get your principal back with interest. You're not going to pay taxes on the principal. All right, you're just going to pay on the interest. You got to tell me that. That's the first thing. State of residence. Why? Is because annuities are regulated at the state level and annuity products are approved at the state level. So I've got to go in based upon your parameters and search for the best approved products in your state. Also, dates of birth. If it's single life or joint life, I got to have that because they price your life expectancy to the day. All of our information you provided me is confidential. We do not share it. You got to tell me if it's a lump sum or if there's a specific dollar amount that you need. That's very important. Okay, we can either reverse engineer for the specific dollar amount, or with the lump sum, we can say, hey, here's the lump sum. Saying how much income will we get under the parameters that I've given you. And then when do you want the income to start? Do you want to start immediately? Do you want it 7 years from now, 6 years from now? Be specific with your request. Tell me exactly how you want it to work in your dream scenario. I'll tell you if it's contractually possible. And if it is contractually possible, I'll go quote every single carrier that's approved in your state and find you the highest contractual guarantee. And then the other key is customizing the payout structure. So let's talk a little bit more about customizing the payout structure. And when I say that, what I'm talking about is single life or joint life. Do you want it just to be your life, or do you want it to be a spouse as well? Okay, and that's key. And we'll run them both ways if you want to show comparison. Or you could say, Stan, what's the highest payout ever? Contractually, it's life only. Why? Because when your Learjet hits the mountain, money goes poof, okay, and the annuity company keeps the money. Most people think that's the only choice out there. It's not. It's one of 15 or more choices. You can have life with period certain, which means that it's going to pay you for life regardless of how long you live. But when you die, if you specify a period certain, whatever number of years are left, it'll pay out for that number of years. For instance, life with 20 years certain. If you live 5 years, then there's 15 more years of payment to the beneficiary. So you can set it up like that, or you could do what I like for my clients to do is life with installment refund or life with cash refund. And what this is it's a period certain, but it's calculated to the day of your life expectancy. It's the highest lifetime income stream payment, okay, with full principal protection of the initial amount, meaning that it's going to pay you for the rest of your life. With installment refund, when you die, whatever's left in the account is going to be paid in payment form to your listed beneficiaries. Cash refund it's going to pay you for life, but life with cash refund means that when you die, whatever's left in the account is going to go lump sum to the beneficiaries. Obviously, installment refund pays a little bit more because the insurance company holds on to the money a little bit longer. Or you could say, Stan, we just have a 7-year income gap or a 10-year income gap that me and my spouse need to fill. You could just buy a 10-year certain or a 7-year certain where it just pays for that time period. Once again, customize it. You tell me exactly how you want it to work, and I'll go find those contractual guarantees or tell you if it's possible. And there's numerous other choices. We just covered some of these. There's 15 or more. You could do all kinds of things. Tell me what you want, or at least get on the phone and let's discuss all of the options, okay? Really, income comes down to 2 things, income now or income later, all right? Income now really comes down to 2 products, single premium immediate annuities or charitable gift annuities. With both of these, and we're going to go over these a little bit in detail, with both of these, income starts as soon as 30 days up to a year. So you can say, Stan, I want it to start immediately. Immediately in this world is 30 days. Or you could say, I need it to start a year from now. It's still an immediate annuity or a charitable gift annuity, okay? Or you could do income later. I don't need it now, Stan, but I need it down the road. That comes down to three products: deferred income annuities, QLACs, and income riders. Again, we're going to go over those in just a minute. Income starts as early as 13 months. So once you pass that 1 year point, immediate annuities are off the table. And we're now talking about DS, QLACs, and riders. And you can actually defer up to 40 years with some deferred income annuities. All right. So let's talk about income now. Single premium immediate annuities is the original design. This is the annuity that was originally designed for Roman soldiers and their families for the dutiful service to the Roman Empire. Only annuity type sold until the 1950s in this country, and still, I think, the most efficient way and the highest contractual guarantee for immediate income. It's got tax preferential income with non-IRA money. Why? You're getting your money back with interest, so you're not paying taxes on the principal, you're paying taxes on the interest. And if I do a quote for you that's a non-IRA quote, you'll see the income stream guarantee total and then the taxation of that income stream. In the industry, they call it the exclusion ratio. How much of that income is excluded from taxes? The other is charitable gift annuities. I do not sell these. I think they're great. They're charities that sell these, right? But they're very efficient. And universities, hospitals, nonprofits offer them. So if you went to University of Michigan or University of Florida, University of Washington, University of Southern California, University of Texas, whatever, they all have charitable gift annuity arms that you can get an immediate annuity type payout, and they will actually let you defer. A lot of them do deferred income annuity under the charitable gift annuity structure. The difference is when you die, the charity keeps the money, and that might be what you want. But what I tell people all the time, at least if you're charitable in your giving, or you have a specific hospital, nonprofit, Salvation Army, whatever. Cancer Society, you can go there and see their charitable gift annuities and see if that makes more sense. Big tax write-off up front if you do that, and the organization keeps the money when you die. So those are the two ways to do income now, all right? So let's talk about immediate annuities real quick. Single premium immediate annuities, like I said, first started in the Roman times. It's the only type that was sold here in the country, and I still like them. The big boys play here. You've got to have real reserve requirements to offer immediate annuities. And, I mean, these are the granddaddies that offer them. All the companies that you've heard of and that you feel comfortable with offer these, okay? They're straight transfer risk product. There's no moving parts. There's no annual fees. There's nothing. It's, hey, here's the money annuity company, and they're going to pay you a lifetime income stream based on your life expectancy. No annual fees. It's a commodity quote. I'm telling you, you got to quote all carriers. Do not allow anyone to show you one or two. When I show an immediate annuity quote, I'm typically showing you the top 7 to 10, all right, based upon your situation. And there's not, people say, well, Stan, last month was New York Life, and this month it's, MetLife or whoever. The reason is these things change. They're commodity quotes. Look at immediate annuity or all income annuity quotes, regardless of type, as a gallon of milk. It expires, and you have to requote it, okay? And it's an open market. It's a commodity product, and life expectancy drives the pricing. Charitable gift annuities, it functions like a SPIA. It can function like a DIA. Some offer some deferral time periods as well. You have to check with the specific charity. It can be set up single joint life, and the organization keeps the money when you die. There's actually a overseeing body this isn't just some random, like your university just comes up with something. There is a body that oversees it. It's the American Council on Gift Annuities. You can go to their website and learn all you want about it. They're fantastic people. I don't sell them, okay? You can't sell them. I don't work for the charity. The charity will offer that, okay? But I encourage you to at least take a look at it, all right? Now, let's talk about income later products. Remember we talked about that? Deferred income annuities. It's the same structure as an immediate annuity, no moving parts, no annual fees. A qualified longevity annuity contract is actually a deferred income annuity, but you can only use it in a traditional IRA. You might be familiar with it. One of the reasons I encourage you to get my books is to read about these products, all the details. And typically my owner's manuals, by the way, they're 50 to 60 pages. You could read them in 20 minutes. You can go through it, and I actually bullet pointed some things. But this product here was originally offered 2014. That's how young this product is, okay? And the rules is right now the rules are the lesser of $125,000 or 25% of your total IRA non-Roth type assets, okay? So income riders are the other way to do income later, and most agents and advisors lean here because the commissions attached to indexed annuities or variable annuities, which is where income riders are offered primarily, a little bit higher. But when I show income later, I show both deferred income annuities and income riders, and then we talk about the value propositions of each because each are different. They both have different value propositions. So it can be attached to deferred annuities. It's a separate calculation that can only be used for income, okay? So if someone says, hey, I can get you 7% annuity, what that agent is talking about is a 7% income rider, which is monopoly money and a phantom account that can only be used to calculate the first income stream payment. So Jimmy Carter's not in office. There's not some 7% yield. And if you don't believe me and you bought one, call the carrier and tell you to try to get them to send you the money they can. Okay, so it's not that they're bad. They're just sold wrong. Income riders are good for income later, but you got to understand, the limitations of the product. So let's go through specifics of these as well. Deferred income annuities, also called longevity annuities. So if you hear longevity annuity, that's what they're talking about. Again, it's an immediate annuity design, meaning no moving parts, no market attachments, nothing. You can just defer it from 13 months up to 40 years, no annual fees. It is, once again, a commodity quote. There's about 16 to 20 companies, big boys, that quote this, and we're going to quote them all for you, okay? So deferred income annuity, when we're doing income later, we're going to show you this and then explain. Again, the owner's manual helps here as well because it explains the good and the bad. And life expectancy, once again, is the primary pricing mechanism, okay? Qualified longevity annuity contracts, introduced in 2014 by our friends at the Labor Department and the IRS. It was originally introduced for the younger workers, okay, to start planning within their 401k for future income. So with some 401k plans, these defined contribution plans, qualified longevity annuity contracts are offered in those for the younger workers to start planning. It's kind of like the government tapping those youngsters on the shoulder and said, hey, stop depending on Social Security as your retirement because it wasn't set up for that, right? Now, the good news is that when they came up with it, they also included it within a traditional IRA structure, not a Roth, traditional IRA. So the rule is you can use the lesser of 25% of your IRA total assets. So if you got 6 IRAs, 25% of that total of those 6, or $125,000, whichever is less. And what happens is when you go take your required minimum distributions, that amount, let's just say it's $125,000, is not used to calculate your RMD. So for example, you got a $500,000 IRA total, which would allow you to put $125,000 in a QLAC. You can defer that QLAC to as far out as age 85. You don't have to go that far. But when you go to calculate your RMDs, instead of calculating on 500,000, it would be on 375. 500,000 minus the 125 is 375. And the good news is you can attach your spouse as a future joint annuitant with it. So you can literally take your personal IRA and you can turn it into a pension for both you and your spouse. And that's a good thing. Okay? No moving parts, no annual fees. Income riders. Let's go over that real quick. Primarily test the VAs and variable annuities and indexed annuities. It's a separate calculation from the accumulation value. Draw a line down the middle of a blank sheet of paper. Left-hand side is the accumulation value side. Variable annuities, that's the separate accounts called mutual funds, also called mutual funds. With index, that's the index option. If you draw a line down the middle of the page, left-hand side is that accumulation. Right-hand side is the income rider calculation. 2 separate calculations, okay? 99.9% of the time, the right-hand side, the income rider calculation is going to be higher than the accumulation value side. It's just the way they design it because they want to hold on to the money. Because the rider side, you cannot transfer that amount, that right-hand side amount. You can't peel off the interest from that, and you cannot cash it in lump sum. The only use is to calculate future income at a specific time, period. So it's monopoly money. Look at it as a phantom account. And what happens is, for instance, if there is a 6% income rider on the right-hand side, it's going to grow by 6% during, that sounds great, doesn't it? But it's not true yield. It's just a phantom account. But it grows by that amount until you turn on the income stream. Once you turn on the income stream, that growth, that 6% or whatever it is, 6, 7, 8, whatever, goes away. Poof. All right? These are also commodities. In other words, don't let somebody say, I've got the best income rider. They don't. Income riders, I mean, you have to quote all income riders for future income, for income later, and see who has the highest contractual guarantee. Just because somebody puts a bonus or a high percentage on an income rider does not mean it's going to have the highest contractual payout. There's a lot of bait and switch. There's a lot of shiny thing stuff going on out there. That's the reason you got to quote all carriers. All right. So what about inflation? Hey, Stan, what about hyperinflation? What about inflation? There's not an annuity on the planet that really tracks it and solves for it. Can we just say that right there? Now, people say, well, Stan, some guy showed me a cost of living adjustment rider, which is an amount, a percentage that you can say, hey, Stan, I want my income stream to increase by 3% for the life of the policy. Sounds great, right? Or you can say, Stan, I want it to increase by CPIU, Consumer Price Index. You can attach those increases at the time of a payment of a deferred income annuity or an immediate annuity, but guess what the insurance company does? Guess what the annuity company does? Guess why the annuity company has the big buildings for a reason and has the logo on the planes? You know why? Because they lower the payment. They significantly lower the payment. And depending on your age, it can be a 5 to 9 year break-even point using the exact same annuity with and without a cost of living or CPIU increase. In other words, when you want it to increase, they're just going to lower the payment, they meaning the annuity company. Now, Social Security, I've come up with a little acronym. It's a VIA rider, voter inflation adjustment. Why? Because politicians know that people that are getting Social Security, they vote a lot. They're frequent voters. So I call this the voter inflation adjustment, meaning they're just going to raise it to get you to vote, and then us taxpayers will have to pay for it. But that's the best inflation annuity on the planet. Okay, so when you look at, and I'll run both CPIU or COLA increases and compare it with the same quote, with and without the same product, with and without that rider, so you can see how they price it. And maybe in a laddering situation, you buy one with and one without. But what I want you to understand is it's not too good to be true. And annuity companies don't give anything away. All right. The other thing that kind of bothers me is index annuity gunslingers. I call them gunslingers because they only sell index annuities. If you had like the flu, they would prescribe an index annuity. Or if you like sprain your ankle, you need an index annuity. Or if you got wrecked your car, oh wait, you need an index annuity. No, index annuity, same thing. If someone says, hey, I have an index annuity that increases the income on when the index increases, what are they doing again? They're lowering the payment if you compare it to income riders that don't have that potential. All right. So the other thing about inflation, I tell people all the time, nobody knows what inflation is going to be, right? So the best thing to do in most cases is when inflation hits or when you need more income gap to be filled, you buy an immediate annuity at that time. That's really the most simplistic way of doing it. So the key point really is annuity companies will lower the initial payment if you attach one of these increases, if you attach a COLA, or if you attach a CPIU increase, or if you buy an index annuity with the hopes and dreams that the index is going to keep up with inflation and it's going to increase the income stream. They're just going to lower the payment. So you have to look at the math. You have to look at the break-even points. Hey, what happens if I didn't get that COLA as opposed to getting that COLA? And we'll run those comparison numbers for you. You already own the best inflation annuity on the planet. What is it? It's the voter inflation adjustment, Social Security, right? Key thing with the quotes, IRA, non-IRA, all right? You need to let me know that because, DIAs and SPIAs, deferred income annuities, longevity annuities, single premium immediate annuities, have preferential income streams when you use them in a non-IRA account. Why? You're getting your principal and interest back at the same time. You're paying taxes only on the interest, okay? In the industry, they call that the exclusion ratio, which means what part of the income stream is excluded from taxation, right? Okay. An IRA annuity, when you have an annuity inside of the IRA, I don't care what you have inside of that IRA. The money coming out of it is going to be taxed at ordinary income levels, all right? And if anybody tells you that they figured out how you not to pay taxes on your IRA money that's been deferring for all these years, run down the road screaming like your hair's on fire. No one's figured that out, and the IRS isn't going to allow that nonsense, and you and I both know that. So don't fall for it, all right? Income riders, in a non-IRA account are taxed, like DIAs and SPIAs have a tax preferential treatment. Income riders, they're taxed last in, first out, meaning gains first from the start, whatever you pull out. So understand that. And when we run your income floor quote, we'll talk about the taxation. I'm not a tax person. You need to talk to your CPA and tax lawyer, but we're gonna lay it out enough for you to take that information to them and then sign off on it. Okay? Laddering strategies. Let's talk about that. There's two ways to ladder. You can ladder the purchase date. You can say, hey, Stan, I'm thinking about putting $500,000 in an immediate annuity, but I feel kind of queasy about a lot of things. And you know what? Let's ladder the purchase date. Let's buy $100,000 for the next 5 years. Now, what happens there? If rates don't move, you're still older, so the quotes will be higher because your life expectancy will be less. And if rates do move in your favor, even though it's a secondary pricing mechanism of this, you are going to get a better quote. Or, so you could buy for every 5 years. Or you could say, hey, Stan, let's ladder the income stream. The best way to really combat inflation is to have income starting at a future date. For instance, like a qualified longevity annuity contract, you can have that income starting, at age 85 or sooner. You don't have to go as far as age 85. That's what they tell you. But with income starting at different intervals as you get older, that's the best way to combat inflation. So in other words, you could buy three annuities at the same time with income starting at different dates. Let's just say you're 70. You could have, income starting at 75, 80, and 85. Okay? So that's another way to do it. And then, or you could say, hey, Stan, let's ladder the purchase date and let's ladder the start date. Once again, tell me exactly how you want the income floor to work for your specific situation, and then we will customize that quote for you and quote all carriers. Okay? So how do you get started here? I mean, what do we do? 3 primary questions. Let's go backwards. How much income do you need on a monthly basis? All right, you can say, hey, I added up all of those things. I added up Social Security, my pension, dividend stocks, my rental property, the REITs, the bonds, but I need this. I need this amount monthly. Tell me what that amount is. Tell me if you want it to be joint or single life. Or you can say, hey, Stan, I'm thinking we need some income. Tell me what this lump sum would produce. Then you say, tell me when you want the income to start. That's a big deal. So you want to know how much, you want to know when it's going to start, and then how do you structure it? Joint life, single life. Say, hey, Stan, I want, and put it in English to me. Hey, Stan, I want to make sure that the beneficiaries get all the unused money. I don't want the evil annuity company to keep a penny. Or, hey, Stan, I could care less about my beneficiaries. I do not like them anymore. They have enough money. They've got enough money from me. Just give me and Marge or me and my partner the highest contractual guarantee possible, and we'll do that as well. So just tell me how to do that. So specific quote information needed, IRA or non-IRA money, state of residence, single life or joint, lump sum, when you want the money income to start, and base your decision on the worst case. And let us and tell us exactly in English how you want the payouts structure to be customized. And just email me the specifics. By the way, I don't have any junior agents work for me. You get me. I know we got thousands of clients. I get it, but you're going to get me. I'm not farming you off to anybody. You're going to talk to me because I got to sign off on everything. I got to take responsibility for the recommendation, and I will. That's not going to be farmed off. You're going to talk to me. All right? So the next steps, hey, here's what you need to do. You need to order the books, my gift, no cost, no obligation. It comes in a Willy Wonka gold bubble mailer. Remember Willy Wonka with the golden ticket? If you don't, go watch the movie. But it's going to show up in this really shiny thing, okay? Request a quote. Tell me in English what you want it to do. Be specific, okay? Don't be vague. No cost or obligation or pesky phone calls or some junior associate showing up at your door. We're going to treat you like a grown-up, and we're going to have a professional relationship. There's no obligation. There's no expectations. I just want you to respond, when I shoot you an email, and be honest. How about that? That's the deal. You can set up a phone appointment with me if needed on the site. When I send you an email, there's a link to that as well. And you can just pull my schedule and set a time, and I'll call right on the nose. And that's a reflection of the military school my father sent me to. So with that being said, as this was going on, I was writing down the top 5 questions that were out there. And you can email me your questions as well. In fact, as I'm answering these questions, you can text me them, the questions. You could email them to me. You can call me with them. But here's the questions in order that my assistant was sitting here going through them, and she chose them. So here's number 1. Can I combine IRA and non-IRA assets? The answer is yes. Just be specific and tell me which assets you're talking about. Say, hey, Stan, 200,000 is an IRA and 122,000 in a non-qualified, and we'll pick the best products for the best taxation of that income stream based upon what you tell me. Okay, so that's the first thing. You can use IRA and non-IRA assets. Number 2, here's the second one. Let me see. Can I see single life quotes and joint life quotes as a comparison? Do I have to choose? Like I said in the presentation, you can say, hey, Stan, I want to run my life only and me and my spouse, and I want to see what the difference is. And if the difference, you need to do that just to see how they're pricing the life expectancy. And a lot of times the difference isn't that much. And again, I will tell you to customize. We can customize that structure. So tell me, hey, Stan, I want any money left over to go to the beneficiaries. I don't want the annuity or not, but be specific on that. Okay. Number 3, why does my state of residence matter? Aren't annuities all over the country? Yeah, they're national, but annuities are regulated at the state level. So when a New York Life or a Pac Life or a Nationwide goes out there and offers a product, they literally have to get them approved in each state. I know that's crazy, and I'm sure it's a very good revenue stream for the states. But the bottom line is not all products are approved in every state. And so when someone says, I have the best product, no, they don't. And it's typically, they're probably selling in a 30-mile radius, and they just learned one product, and they can sell enough to go on a trip to Italy or something. Tell me your state. That's important. Your state of residence. Okay, state of residence. Number 4, is there any cost or obligation for the books or quotes? I think I covered that. I'm going to cover that again. No. And test me on that. I mean, just you're going to find out that I will provide you the books. You could go buy them on Amazon and make my wife extremely happy because we get all those royalties. Or you can send me an email at this email address with your physical mail address. I'll ship them to you. Number 5, and the last one is, should I wait for interest rates to go up more? I'm going to tell you no. Don't be a genius. Nobody can figure out rates, but I will tell you, if it does still make your stomach hurt, then you can ladder the purchase date, like we talked about the laddering, which is, for instance, you had $300,000 you want to buy SPIAs with, immediate annuities with. We buy $100,000 a year for 3 consecutive years. Last one I'm going to throw in because I just saw it. Someone talks about life insurance for income. All I'm going to say is when you get, and I'm not going to go crazy on this because my head could pop off if I really thought about it. But anytime you take money out of a life insurance policy, it is a loan. Let me repeat that. Anytime you take money out of a life insurance policy, it is a loan. It's not tax-free income. Now, the reason that the people out there selling that stuff is saying tax-free income is because loan is not an income, right? All right, semantics, but do not. Life insurance is a great death benefit. It's the best return on investment you'll never see. Why? Because you're dead, right? So it's not for income. We do not use that in our income flooring strategies. So with that being said, contact me. Let me run the customized quote for you. No obligations. Be very specific on what you're trying to do, either a specific number or a lump sum, and we will get you those quotes. Typically turn it around about 24 hours. My staff's fantastic because we got to quote all companies. So I want to thank you once again for attending. And I hope to you attend the next one. We're going to be doing these monthly, so check back, and you'll get some invites on